Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us. I hope you all had a lovely weekend and looking forward to what looks to be a really interesting week. It's been obviously a pretty slow start to the week, generally speaking. That's not altogether surprising. I think Mario Draghi, as you can see from my latest piece on the OANDA MarketPulse website right in front of you, he's given us a little bit of something to talk about this morning. The markets were very flat, similar to how they were yesterday, really, ahead of his press conference, his speech. And to be honest, expectations weren't particularly high going into this speech. I think people were just expecting relatively flat markets really heading into tomorrow's Fed decision, and we will come to that in a second. But it was quite interesting that this dovish Draghi syndrome, that this idea that no matter what's happening, he can talk down the currency. It just continues to happen. It seems like markets are constantly expecting something different. This kind of definition of insanity, the doing something over and over again and expecting the outcome to be different. And it seems that Draghi just has not lost that knack of being able to talk down the euro. And let's face it, there's nothing he said that's altogether too surprising either. He suggested that the asset purchase program could be expanded. Well, we know that. They've only just finished it. We know it can be expanded. There's always more ways in which that can be done. He suggested that rates could go lower. And yeah, do you know what? I mean, they probably can go lower. Probably not really that significantly, let's be honest. They're in negative territory already. The deposit rate's minus 0.4%. But yeah, maybe another 0.1, 0.2 wouldn't be outside the realms of possibility. But we've got to remember that they started the asset purchase program because they were concerned about the negative impacts of interest rates. But again, nothing we've heard here is altogether too surprising. So it was quite shocking to see that the euro responded so strongly to his comment. And again, when I say strongly, it fell off 50 pips, but that's quite a considerable move. And the knock-on effects that that had across the markets was actually quite significant. We saw European indices trading around 0.5–0.75% higher, which, given that they were flat to begin with, I think is quite significant. We saw German bund yields hit record lows. The German 10 years hit record all-time lows. I mean, that's incredible. They were already trading near that territory, of course, already. But the fact that we moved into that territory based on these comments, I thought was quite really quite interesting. So Draghi's provided a little bit of a distraction, thankfully, today, because I think otherwise, if you're outside of the UK, it could have this could have wound up being a relatively slow session, to be honest. I think this week as a whole, like I say, there's plenty to look at. And for a roundup of everything that we have this week, you just click on this economic calendar here, which takes you to this screen. Now, I've filtered the calendar using the filter button here, just to cover the instruments which I'll be talking about today, and also looking at medium and high tier events only. That a couple will drop off as a result of that. That may not be low tier, but are marked as low tier on here. But I wanted to get rid of the noise, and we don't want to be looking at things which aren't particularly important. So this is the events page that we have ahead for this week. And as you can see, we've already had plenty of economic data, things like Eurozone inflation, although that was in line with expectations. But we do have plenty more to come. So a nice, busy week ahead of us. And I think there's going to be a major UK focus, to be quite honest. So I'll start with the UK. I hope that's okay for those of you who are outside of this country. But I very much, unfortunately, in many ways, engrossed in it. So yeah, I mean, for the UK perspective, the week begins today. Now we've got a Mark Carney speech here. I can't imagine that we're going to hear too much. I'm not even sure if he's allowed to say too much about monetary policy, because I know the Fed in the US has a blackout period which starts the Monday, the week before the actual meeting. So it would have been a week ago yesterday that the blackout period started. So no monetary policymakers are allowed to discuss monetary policy in public. I'm not sure if the Bank of England actually has that, but I imagine Carney won't want to preempt Thursday's meeting in any major way. So we'll see how that goes, but I'm not expecting too much. The reason why it really starts today is because the leadership contest continues. The Conservative leadership contest, which is now whittled down to 6 candidates, including the front runner, by far and away the front runner, Boris Johnson. Boris is a Brexit campaigner. He in my opinion, he very strongly influenced the outcome of that referendum back in 2016 when he chose to back the Leave campaign. He has since obviously put his name in the hat to become a leadership contender, although this has long been touted. We're talking 5-10 years this has been in the making. He's been getting asked questions about whether he has aspirations to be leader. He's always knocked them back, but it's always been perfectly clear that this was his ultimate goal one day, and I think potentially used Brexit as a means to achieve that goal. But where that leaves us now is he's strongly an advocate of course, leaving on the 31st of October. He said there will not be an extension under his leadership. I'm skeptical that that's true. And he said that without a deal, he'll leave with no deal. So from a market's perspective, he and Rob, who share similar views, are probably the worst outcome because they increase the possibility of a no deal. Unfortunately, from my market's perspective, he did receive 1/3 of all the votes last week. So when the number of MPs was reduced from 10 to 6 last week, candidates had to get 11 or was it 12 MPs to back them in order to make it through to the second round, and 3 failed and 1 has since dropped out. He received 1/3 of all votes, and he was around 71 votes ahead of second place. So he received 3 times as many votes as the Jeremy Hunt, who finished in second. So quite the considerable lead heading into this second phase. He was not present for the debate over the weekend. I think he thought that 6 different Conservative MPs rounding on each other may not be the best public thing to do. Again, I'm quite skeptical because I think it's quite clear that what would have happened is 5 of them would have rounded on him as the front runner, and I think that's what he effectively decided to dodge, despite his PR message, which was sent out ahead of that. He is going to appear on the debate tonight, assuming obviously he goes through, which he will. And there's another vote today. So today, I think it's around 33 votes each MP must get, which is around 10% of the vote itself in order to progress through to the third round, hopefully reducing the numbers by at least 1. If all MPs manage to somehow get 33 votes, which they won't, then it's the candidate who finishes in last place will be eliminated from the race, which means that the BBC debate tonight will have at least 5 members. Now, I've just given you some background. Most of you will not be in any way interested in that, and I do not blame you, to be quite frank. Most of the time, neither am I. But the important thing is here, it's who gets eliminated at each stage and what we're left with, because ultimately, from a market's perspective, someone like Jeremy Hunt is probably more favourable. They've all committed to exiting the EU, so that's almost effectively baked in. But it's the ways and means in which they want to achieve it. Jeremy Hunt is strongly against leaving with no deal, so he'd probably be seen as the more favourable candidate. And there's 1 or 2 others in the same way, and then you've got the Michael Goves, who falls somewhere in the middle. So it really is important how many get knocked out. For example, if the final 2 is Dominic Raab and Boris Johnson, then that's seen as by far and away the least favourable outcome here. So I think this is going to be interesting today. We'll have a second round of voting then on, I think it's Wednesday or Thursday, and then if there's more than 2 left, then on Thursday we go again. And what this means is by the end of this week, we will know the final 2 candidates who will be put forward to the 16,000 strong Conservative membership across the country. Not a very big number, which is surprising that so few people in this country will determine the next leader of the next leader of the country, the next Prime Minister. But that is how it is. And then they will have 1 month in order to submit their votes, and then we will have our next leader on the 22nd of July. So until then, there's nothing we can really do on Brexit. All we can really do is watch who's likely to be elected, and now you're seeing markets respond to that. And we will come to the pound in a second, where you'll get to see just how they are reacting to the prospect of a Boris Johnson leadership, which currently still very much looks the most likely. He's not just the most favoured in Parliament currently amongst MPs, he's also probably going to be the most favoured amongst the Tory membership. Tory membership on a poll done by the Times, or conducted alongside the Times, I forget, showed that there's still a large portion of Tory MPs who want to leave the EU, and there's still a large proportion of the Tory membership that want to would happily leave with no deal. So someone like Boris Johnson very much speaks to those members, to those voters to those decision makers ultimately when it comes to that race. And that's where someone like Jeremy Hunt may actually struggle if he gets down to the final two. There's been reports today that Johnson is effectively going to lend 15 of his MP backers to back Jeremy Hunt because he'd prefer a face-off with the Tory membership against him. Again, this is speculation. Very dirty tactics if true, and I'm sure there'll be a lot more follow-up on that if that is found to be accurate. Not that it'll probably have any influence on the actual outcome. So that's where the leadership currently stands on that. And I think that's still the primary mover in the currency markets, in the sterling currency markets right now. We do have other things like CPI inflation data and retail sales data from the UK. I'm not sure this is going to be that massive this week because as far as markets are concerned, these are only really influential if they're going to influence the path of interest rates. And at the moment, markets, this was as of yesterday, I haven't checked it today, markets saw a 75% chance of no change in UK interest rates by August next year. Quite a considerable thing, which obviously is linked to the uncertainty still surrounding Brexit, surrounding the leadership challenge campaign as well. Which brings us to the Bank of England decision on Thursday. Again, I don't think this is going to be a game changer. I don't think this is going to be a knockout. I think it's going to be very straightforward. I think Bank of England policymakers probably have the easiest job in the world right now. They sit down once a month, they have a quick discussion, they all nod, they leave, and they say no change, and we move on to the next meeting. It's hard to really get them to justify any otherwise. We're seeing subdued economic growth. We've got record low unemployment. We've got 4-decade-long low unemployment, which is obviously strong. We've got inflation at target. There's nothing really pushing them to either cut or raise interest rates at this moment in time. And of course, this deadline in 4.5 months now may very much change that. So I think we're not going to see much from them over the coming months. And when it becomes clear how we're looking on the 31st of October, then we may start to see interest rate expectations changing. So that's the UK covered. The rest of the week, again, we do have some US housing data. We've got some features from various ECB policymakers at this summit in Portugal that they are currently attending. So we seem to be hearing from Draghi on a daily basis. I'm not sure what he's going to be able to add to today's conversation, again, which wasn't altogether shocking, but did influence the markets. Inflation data from Canada, I think that's quite interesting. Canada does tend to mirror the kind of moves that we do see at the Federal Reserve. And if this data is correct and we're seeing core inflation drop to 1.2% from 1.5%, then potentially they have a catalyst, they have a reason to be cutting interest rates, potentially even before the Fed does. Certainly want to keep an eye on. The Fed decision on Wednesday is by far and away the biggest event this week from a markets perspective. And the reason is this: the Fed is currently projected to leave interest rates on hold, and the market put a probability on that of 82%. Now that's quite convincing. So you may be wondering, why on earth is expectations so strong that they won't move, and yet this is being viewed as a major monetary policy decision? Well, the reason why people are so convinced they won't move is because the G20 is next week, which is when Trump and Xi are scheduled to meet and discuss the impasse which has been created in trade discussions over the last few months. Just as we thought a deal was coming, we did see talks break down, and ultimately the amount of times that the Fed is forced to cut interest rates over the next 6 to 12 months is likely to hugely depend on how these trade discussions go. If we get a resolution here, then we may see 1 or 2 cuts over the next 6 to 12 months. If we don't, then it could be much more, because the economic impact of further tariffs could be more significant. We could see a more severe slowdown, and then that will force the Fed's hand, especially at a time when inflation is slacking. So people are putting a lot of weight on that meeting next week, whether we're going to get good news or bad news. And until then, it's very difficult for the Fed to actually cut interest rates. The flip side is markets clearly don't think anything positive is going to come from next week, because the markets are still pricing in more chance of 3 rate cuts than not by the end of this year. And given that we're in June, that's staggering. And on top of that, they're strongly pricing in the first rate cut in July, which is when we'll know the outcome of the G20. I would expect that to significantly change should we see a positive outcome at the G20 in a week's time. So what we want to see from these numbers is what's the Fed thinking currently, Is the Fed in line with the markets of 2 to 3 rate cuts this year? If not, why? Where does it stand? When's the next rate cut coming? Will we see a strong hint at July? We also get the new economic projections, which is really awkward for the Fed because that comes alongside the dot plot, so they get to lay out where they actually see interest rates this year. So I think that's going to be quite significant, and where they see the path of inflation going, what's changed from 3 months ago. Now, typically the Fed will, over the last decade, has cut or raised interest rates at one of these quarterly meetings or announced stimulus, etc. But given that this comes so close to the G20, they're going to be very reluctant to. So July would actually mark the first time in a number of years when they would change, when they would alter monetary policy without releasing new projections. So that would be really interesting. So it will be really interesting, and I think that could be a big market mover on Wednesday evening UK time, Wednesday afternoon, obviously. If you're in the US, Bank of Japan will be less so. Again, like the Bank of England, they're just not going to do too much at the moment. Then we may start to see hints that we're going to see some more asset purchases of some kind, more experimenting with negative rates, maybe more experimenting with 10-year bond targeting, that type of thing. But I don't think we're going to get anything hugely significant. I've not seen anything to suggest otherwise. And then we wrap things up on Friday with the manufacturing services and composite PMIs from Germany, the Eurozone. We get some from the US as well as retail sales from Canada. So plenty of economic data still to come this week. So like I say, it's a real knockout week. There's no absence of stories. And that's without even going into things like the oil story, the Iranian issue over in the Gulf of Oman right now, which, because this is an FX webinar, I won't go into any detail and waste any of your time. But that's a huge story in the markets right now. And if any of you want to know any more, then please don't hesitate to reach out to me on Twitter. It's Craig_Forex. I'll happily have a chat. Maybe it's something we can talk about in the webinar in a couple of weeks' time. Or if you want to hang around after, then I'm happy to actually take questions once the webinar has actually come to an end and people have got from this what they actually came for. As ever, please do just send any questions through. I'm always happy to answer any questions if I can. And in the absence of that, I'll just crack on with the charts in the usual order which we cover them. So first up is euro dollar. Now, as you can see, we're continuing in this downtrend. We had a little bit of a tease a couple of weeks ago when we broke through 113 and we were potentially breaking out of this long-term descending channel. We failed to hold above and we reversed back in. Now, there's always two ways to look at this. There's the way of, if we see a breakout and we don't see it act as a catalyst for another move higher, are we actually looking at a false breakout? Is this just effectively catching those who are too eager to get in? Now, one of the things that made me a little nervous is the fact that we do have the 200-233 moving average band here just above, and the fact that we held below there I think was always going to provide some extra resistance to make things a little bit more challenging. I think a breakthrough 114 would be more significant. So we've reversed in almost immediately after, which takes some of the steam out of that initial breakout. That being said, I'm still not convinced that we haven't seen a breakout longer term. And the reason is that we haven't seen enormous momentum build into the downside. We saw this one big downside day. We have broken through the 61.8 fib, but after such a long downturn here in this currency pair, I'm willing to keep an eye on the 78.6 fib around 111.50. If we break through there, then obviously all eyes then go back to these lows. And if we can break through there, then it would suggest we're going to see a continuation of the downtrend. But I've not given up hope on a breakout to the upside just yet, because it does feel like we have seen a bit of a momentum shift from what we've seen previously. We have seen the dollar coming in under a bit of pressure. Of course, one of the things which could change this would be for the Fed to become more hawkish or be less dovish than the markets are expecting, and the markets are very dovish right now. So again, Wednesday becomes all the more important. We have seen a deterioration. We have seen a drop in the euro today on the back of those Draghi comments, which is what's guiding it lower through the 61.8 fib. Who knows, in the absence of those comments, maybe that 112 level holds. But again, I'm not losing hope on it just based on that, because I don't actually think Draghi said anything new. So I think there's no reason why these declines couldn't actually be reversed. If we look at the 4-hour chart, for example, I'll be very interested to see how we hold here on this momentum indicator. We've already seen divergence forming on the MACD histogram. We're seeing a flatlining on the MACD moving average, and the stochastic isn't showing us a new low at this moment in time, despite price making a new low. So we are losing some momentum as we head towards these 111.50s, despite the sell-off that we actually did see this morning. Over in cable, as I said earlier, we have seen weakness in the pound, linked to this leadership contest, linked to the emergence of those who strongly favour Brexit and also favour no deal rather than an extension of the 31st of October deadline, especially those who are trying to find ways to basically subvert parliamentary democracy and find ways to get around Parliament blocking no deal Brexit, which is incredible given that we've repeatedly been told over the years that a second referendum would be an assault on the democracy in the country because people voted that way. To then try and subvert Parliament, I fail to see the difference, to be quite honest. This is something that Parliament should agree on. We voted Brexit. At the end of the day, the Brexit should be delivered upon, but it should be done so in the right way. And the idea of going around Parliament, I think, is absolutely ludicrous, quite frankly. And this doesn't help me trust the judgment of candidates like Dominic Raab, the fact that he can't find a more creative way to negotiate and come to an understanding with other MPs. And at the end of the day, if MPs can't find a way to do it, then you have to have an election and allow the people to put in place the MPs who will deliver on their wish. The idea has been put forward now are quite frankly ridiculous, and I've struggled to see them actually happening. But it just goes to show that the kind of the views and the ways and means that candidates are coming up with who are actually campaigning currently and still in the race, which naturally makes pound traders a little bit nervous. So what we've done is we've finally broken through these kind of 126s, 125.50s. We're heading lower, 124.50 through 125, 124.80-ish. This is the next major level of support. A breakthrough here now would take us back towards the kind of lowest level since early 2017. It will be, again, a look at the 4-hour chart. We can see how we're doing from a momentum perspective heading into this, and you can see that the MACD moving averages are still heading lower, same with the stochastic. To an extent, we've had a little bit of a blip on the most recent decline, and we're flattening on here. So we're not really seeing too much lost momentum at the minute as we head into those 124.50s. That can obviously change as we continue to dip lower, but I do think it just goes to show a nervousness, and this is at a time when we have seen some dollar weakness as well. The fact that the pound is just outstripping it is quite interesting. Of course, if we look at the new lows that we've made here on the daily chart, then these moving averages, these indicators tell us a different story, because we've very much got higher highs on the MACD histogram. We've got higher highs as well on the MACD moving averages. It's only the stochastic which isn't necessarily playing ball. So again, that makes these levels all the more interesting in cable. If we do see a rebound, then obviously 126, 126.50 area becomes the initial line of resistance or potential resistance, because it's the most recent low. But ultimately, as long as a breakthrough 127.50 would be the more significant, 128 maybe, but 127.50 breaking through previous highs would suggest we've got some form of trend change in this pair. I don't think any chart shows the deterioration of the pound more clearly than euro sterling, to be quite honest. I mean, I've said so many times on these webinars, these things don't move in straight lines. They tend to move higher or low, they correct back and they move. Well, that's not very true in euro sterling. This is pretty much moved in a straight line. That very much goes to show you the mood that we are seeing right now. That being said, it has been rallying now for more than a month. We have hit new peaks even earlier today, before they reversed on that Draghi news, but we are very much seeing divergences now. We've got the MACD histogram, which has made new lows on each of the last 3 peaks. We've got the MACD histogram moving averages, which flatlined on the most recent peaks and looks to be making a lower high on this occasion. Only the stochastic is really not playing ball, but again, it's flatlining. We're not seeing really new peaks being made, which suggests to me that we are seeing some momentum shift. And coming around that kind of 90 level, suggests to me that we are potentially now correction bound. If we do see a move to the downside, then this 88, 88.50 level becomes interesting. 88 in particular because of that 200, 233 day simple moving average, but that entire band initially becomes interesting. And again, 87 below here if we do pull back that far. And should we move into that territory, then I'll also add a fib level to see if it highlights any levels of interest. In fact, let's just do that now, just in case we do see a pullback. So yeah, the 50, 61.8 fib area, it comes around that kind of 87 level, 38.2 around 88 again. So potential levels here of interest, although we're still at or around the peak. So it's probably a little bit early to be looking back that low just now. Aussie dollar, we've seen a break lower, not really heading in the direction I wanted to head. I've made it perfectly clear on these webinars in the past. I would much rather see a break through 71, 71.50 than lower, but hey ho, that's where we're heading. There's no point in ignoring the charts. We made a new low. We rallied back towards the 50 fib. We fell just shy, falling off the top of the rising channel here. We then broke through the bottom of the channel, and since then we've just headed lower into new territory. We highlighted this potential level of support here around 68.30. Again, we had to go back a long time in order to actually find a level that was previously significant, but it was back here in early 2016. Again, you sometimes wonder, can a level that was significant that long ago really play a role here? And I'm always a bit skeptical, so I always add it as I always say, a level of interest rather than a notable support level, notable support area. But it does seem to have held on this occasion. So we did run into support here. We're around 68.31. That was 68.27. I mean, we are within a few pips. So it's clearly respecting that level of support, which begs the next question: how's the momentum looking on this decline? And again, the momentum seems to be okay, if I'm honest, on the stochastic, but the MACD histogram very much doesn't necessarily concur. So potentially, and the fact that we've already run into resistance so quickly after this low, potentially a bit of a warning sign. But the important thing is we did have that nice little corrective move. We did rotate lower out of the rising channel, and then that took us towards these new lows. So we can remove the noise now off the chart. And now it's a case of where we are heading next. If we do rotate to the upside, we could see early resistance here around the kind of 68.50, 68.75s, but I'm not necessarily convinced. It feels a bit soon. I'll still be keeping an eye on this support area here that we had previously, but ultimately it's 70 to the upside that's significant as far as I'm concerned. Dollar CAD. Now, you'll remember that I was getting very happy at the direction of travel that we were heading in. Previously, we did break out of that rising channel. It was an imperfect channel, as I've highlighted again in previous webinars, which meant that I was a lot more interested in this. This was just potentially a warning sign that we were breaking out. It was the moving average band, the 200, 233 day simple moving average band, which we've respected on a few occasions. We did pierce it here before breaking higher, so we did have a fake out there, but twice since again, we have respected it, and we've respected it once again. And again, now I'm not giving up hope on this just yet. I'm desperate to see a break lower. Interesting that we've come higher and we've actually run into resistance around this previous area of support during this period here, around these kind of 134s, which coincides roughly with the 50 and 61.8 Fibonacci retracement band. If we break high, then again, I'll keep an eye on these kind of 135s. I'm not always interested in 78.6, but the same rule as applies as earlier. I'm very curious with this one because I think we have seen this move back here, but I'm just not necessarily buying the actual rally at this moment in time. Perhaps I'll be wrong, and we'll see how things go. And if we break through this 61.8, I may start to get a little bit not nervous, but the red flags may start appearing, and the breakthrough here, and I think it's pretty much done, and we're just continuing in this slow grind higher. I'll remove these lines again, the noise. I'll leave that one on here. It's a bit longer term. We haven't broke above. So yeah, a few interesting levels to be keeping a close eye on there for the US dollar versus the loonie. Sterling CAD, very much like Euro Sterling, has been heading in one direction only. We've now come back to these early 2019 lows around 167.50. We did see a brief retracement in the meantime where we rebounded off these kind of 170s, which was prior support, which became resistance. We've rotated low, we've made a new low. Now, as I've said previously, this may look like a large range, but we've got so many different levels of support along the way. Any entry into here, and my eyes straight away go down here. I want to see if momentum's building into these support zones or retreating. And first instinct suggests they're retreating. You can see what's happening with the MACD moving average. You can see the flattening off in the MACD, MACD histogram, MACD moving average, and the stochastic as well as flatlining a bit, maybe even starting to show some divergence. So that doesn't give me much comfort, not bearish comfort, going into this 66, 67.50 area, especially following such a sharp and significant sell-off. The potential for correction here maybe is a little bit more significant. If we do see a retracement to the upside, then 170 remains an area of interest, but also 170, 150 again, where you've got the moving averages coming in to a market that's starting to trend again, so they start to hold more significance, but also it's a prior area of support and resistance as well. So this kind of area here could be very interesting. Kiwi dollar, this is a little bit interesting at the moment, but it's not necessarily game over. We had the breakout here of the this falling channel, and we started to retrace higher. We added on the fib levels as potential areas of interest. We fell just short of the 50 fib, and we started to cut back. So we added this green fib level here from the lows here to the highs there, thinking there's a potential for us to retrace higher and really test these 50 or 61.8 fib if this is a broader corrective move. But we've gone straight through the bottom of them now. There wasn't even a real test, to be honest. It just smashed straight through them. But we haven't made a new low, not yet. That said, this is quite a significant sell-off, so I wouldn't be surprised to see another test of these kind of 65s, which is held so far. But again, there's a lot of momentum behind this most recent move. You look at the 4-hour chart, and you can see there's considerable momentum here. Starting to potentially see a bit of a flash on the histogram, potentially even a little double bottom forming on this 4-hour chart with the neckline around the kind of 165.15s. Just shy of 164.90 here. But even if that does pop higher, even if we do see the full projection from the lows to the highs, that would only take us through to 65.40 to these kind of levels here. So in the grand scheme of things, not particularly significant, especially when you compare it to this kind of move here. One to keep an eye on. The fact that this has fallen just shy makes me a little bit nervous in terms from a bearish perspective. Yes, we've failed to hold on the fib levels, but this failure just seems a bit odd to me. For me, that's a kind of red flag. We'll see if over the coming hours whether we see a consolidation here, which would suggest we've got a trend continuation pattern and another potential assault on this 64.80, or if we actually do start to rotate higher, because you've kind of got one or two things here. You've got a trend continuation with this coming under significant pressure and this being your next potential area of support, or you've got the potential for a longer term double bottom forming here, which is much bigger, much more significant. So again, we'll see how things materialize over the next few hours. Wrap things up as ever with the yen pairs. And again, we've got consolidation here, but this very much looks like something where the momentum remains with the bears. We've seen the pair pull off a little bit today. Consolidation, we didn't even see much of a correction. We've not even seen a run into the 38.2 or the 50 fib, and it looks like we are pointing lower again today. We've seen such a fine margin of consolidation that I'm just going to take a look at the 4-hour chart here. And again, there's nothing enormous to read from here. One thing is that we've got this kind of short-term resistance around the kind of 108.75, short-term support around 108.15. Depending on which one breaks first, that'll probably be a strong indication, given the fact that both of them now have 3 or 4 touches, top and bottom. So you kind of got this just pure sideways trend now, and have had since well, for just over a week. So if we do see a break lower, for example, today, then that could be a pretty bearish signal heading into these kind of 107.80s, these longer term supports following this period of consolidation. And again, a break below these kind of 108s, and you're looking well back into your charts. And I think I remember saying last time, 107 is an area of previous support and resistance, so it becomes an area of interest. 106 as well, and then 105. these don't come as major surprises, and it looks like I'm plucking numbers out of thin air. But if they've worked in the past, or if they've shown support and resistance in the past, then there's no reason to think that they won't or may not do so again on this occasion. Sterling yen feels very familiar to euro sterling and sterling CAD. Almost a straight line low. We saw a little bit of consolidation here, but not for too long. We ran straight into resistance around the kind of 138.50s, which we'd highlighted on the chart from previously. We rotated off this back through the rising channel, and we headed straight back into these lows here around the kind of 135.50s, 136.50 area. Again, a previously highlighted area of support and resistance from this period back here, back in 2016. Not ideal, and it's very long term, which is something that always makes me a little bit nervous. But it was an area, as I said earlier, a bit of an area of interest, and the fact that we'd found support here more recently only really adds to that. But we've broken through those levels today. If we can close below here, then back towards these kind of 132.50s, 133.50s potentially becomes another longer term area of interest. So the last one was these previous support here. That's more significant given the consistency, the lack of a real break, and the fact that we found support here recently. And then the longer term one is these levels here. So it does make me nervous trying to pluck these levels out, but if we look back on over the longer term, there is an enormous amount of support and resistance during this phase. It was a very choppy period. There wasn't much support and resistance being found barring around these kinds of levels. And if you look further down for your support or resistance for your potential profit taking, then you may be waiting a while, and that's quite a considerable drop. And I just don't see us dropping enormous amounts before running into support again, especially not after such a significant decline. Once again, in these times when there's big gaps between support and resistance zones, I think the momentum indicators are key. And as we can see here, MACD histogram is flagging some potential divergence. The same with the actual moving averages. We're seeing a flat lining of the stochastic as well. So this is something to me which I think is a red flag. The fact that momentum is not on this occasion confirming the actual breakout, potentially signaling a weak trend, and that doesn't give me confidence that we're heading back even as far as these 132.50s, 133.50s. So something to potentially keep an eye on around those big round numbers again, as we said in dollar yen. If we see flagging momentum, then perhaps that's a signal that these big round numbers could come into play once again. And finally, euro yen. We did pull off the lows. We came up to 38.2 fib, and we've just gone straight lower. Very weak trend, not helped obviously by Draghi's comments this morning. We're seeing another run on this low here. It looks as though we were potentially going to see a bit more of a corrective move higher because we broke through this trend line, which only had 2 or 3 touches, so not the strongest. But we've immediately run into resistance at the first time of asking, which is a sign of a strong downtrend. And now this morning's moves have just been exacerbated by that clear bearishness, which we are seeing right now. Of course, the test next is around these kind of 120.75s where we ran into support previously, but below here around 120 through 120.50 again is another one. Once again, I will be keeping a close eye on these momentum indicators, because if we are significantly losing momentum heading into 120, then that could potentially be interesting, given how long the sell-off we've seen in this pair has already lasted. At the moment, we're not seeing any real bullish signals, but those momentum indicators may just be them over the coming hours or days. Okay, that's pretty much it. Once again, thank you all for joining us on this webinar. I hope you all found that useful. If you've got any questions, please don't hesitate to ask. You can follow me on Twitter. It's Craig_Forex. Please don't hesitate to send a message. And apart from that, check out all the content which we push out on the MarketPulse website, which is where you'll find a recording of this webinar later on. You can also find it on YouTube and also, of course, on Twitter. Check out the podcast as well, OANDA Market Insights. You can subscribe on iTunes or wherever you get your podcasts, on Spotify also. And yeah, thank you all very much. I wish you all the very best of luck with your trade and have a fantastic week, an interesting week, no doubt. And I'll catch you all again next week. Thank you very much. And thank you, Nita, also for the compliments. Thank you.